Meet Arthur. He and his wife Rose have been renting an apartment in the city for about 5 years. About 2 weeks ago, Rose told Arthur that she wanted to move to the suburbs because she was tired of all the traffic and congestion in the city. They also have 2 school-age children, and she felt it would be a little safer for them. Arthur agrees with Rose. After watching our Rent or Buy a Home video, Arthur and Rose decided that buying a home in the suburbs is the right choice for their family. Here's the problem. Arthur, the family's breadwinner, cannot actually afford to buy a house. Fret not, Arthur. There is still a way to buy the house of your dreams, even if you don't have enough cash. The answer? A mortgage or home loan. A home loan is called a promissory note, which is just a promise to pay the money the bank or lender lent you to buy your home. Home loans are available for all kinds of home ownership, including single and multi-family homes, condos, home improvements, and even new construction. A mortgage is a pledge of your home as collateral for the loan. Basically, the mortgage allows the lender to take the home if you fail to pay back the loan. This is called a foreclosure. Unlike commercial loans, home loans have 3 major types. Fixed-rate loan, which, as the term implies, is a loan with a fixed rate. ARM, or adjustable rate loan, has flexible interest rates. Hybrid ARM, also known as combination loan, is a mixture of the 2 earlier mentioned loans. It starts off as a fixed-rate loan and ends as an ARM. Now, a mortgage is unique in the sense that the collateral is always the house. If Arthur fails to pay off his loan or misses too many payments, the bank can foreclose his home, which is a fancy word that means take Arthur's home. Home ownership also comes with other expenses. 1. Property tax. This type of tax is based on a percentage of the home's market value. This rate is also based on the percentage imposed by a certain jurisdiction. Say your house is worth $100,000 and the local property tax rate is 1%. This means that you have to pay $1,000 in property tax. 2. Closing costs. This is a set of fees charged when the loan is made. The fees range between 2% and 5% of the purchase price of the house. It could be more if you choose to lower the loan's interest rate with the purchase of discount points, each of which is worth 1% based on the balance of the loan. 3. Insurance. This expense comes in 2 forms: homeowner's insurance and private mortgage insurance, or PMI. Let's expound on the insurance. The homeowner's insurance is a requirement when getting a mortgage. This is also a form of protection because it can help Arthur in case the home is damaged or if someone gets injured on the property. We know you want to know more about this type of insurance, so don't miss our next video, the homeowner's insurance. Now, on to the second form of insurance, private mortgage insurance, known as PMI. This is a monthly reoccurring fee charged to offset the risk of the borrower not paying off the loan. This is not required to all borrowers, which is a good thing because it can be quite expensive. This is required, though, among borrowers who have paid less than a 20% down payment. Now, that's another topic worth talking about. Down payment. What is it? When you purchase a home, the lender will require you to make a certain payment. This is called a down payment. Picture this. Arthur has found his dream home. It costs $100,000. He is required to pay a 20% down payment, which is equivalent to $20,000. Arthur would have to pay this $20,000, while the lender will cover the rest of the amount to purchase the house from the seller, $80,000. 20% is the industry standard for down payment. However, most house buyers make a down payment of 6% or less. There are actually practical reasons for this 20%. 1. Your mortgage is more likely to be approved. 2. You can bypass PMI. 3. You will have a lower interest rate. But what if Arthur doesn't have $20,000? There is still a way for him to own his dream house. He can apply for a loan from the Federal Housing Administration, or FHA. This is a form of loan issued by private lenders, but is insured by the government. This results in a much lower credit score and a down payment requirement of as low as 3.5%. We hope that this has been a learning experience for you and Arthur. This way, you have a better idea on what you will be getting yourself into when you buy a house. Now, you are ready to take out a mortgage and buy a house. Check out our next video and go to our website to find information about mortgages and other related and informative content.